Some markets are seeing rent stabilizations or even rent deductions. How can you protect yourself from this risk? Hello and welcome back. Real estate investing can be a great way to build wealth. However, it's not without its risk. In this video, we will discuss the 5 biggest risks of investing in real estate for a buy and hold strategy and how to avoid them. Whether you are a seasoned investor or just starting out, this video will provide you with valuable insights to help you make informed decisions about your real estate investments. If this is your first time visiting my channel, please subscribe and turn on the notification bell. My name is Korianne. I have been a real estate investor since 2001. I make videos to share my real estate investment journey that got me to be financially independent after 8 years of investing in cash flow properties. I really hope to inspire you to invest in cash flow real estate so you too can achieve your financial independence, build a legacy, and make an impact on the people around you. So let's get into the 5 biggest risks of the buy and hold real estate. The number 1 risk, vacancy. Vacancy will lower your cash on cash return when your property sits on the market for a long time, and you have to pay out of pocket for the mortgage payments and other expenses without income to offset any of it. This is the biggest risk. Here are a few solutions to minimize vacancy of your property. First, you can offer added perks to renters to make the property more appealing. This includes offering free Wi-Fi, free parking, or even a free gym membership. Second, consider changing your prices throughout the year. This can help you attract renters during the slow season. You may consider renting your property 5 to 10% below market value to attract more renters. Hopefully, you have enough cash flow to have this 5 to 10% buffer to offer up as concessions. Third, consider short-term rentals. This can help you fill vacancies quickly and generate more income. Your normal lease term is about 1 year. Now you can be flexible to do shorter terms like 6 months for renters who are transitioned between homes, which happen due to relocations or a new home constructions. Lastly, improve your leasing. This can include improving your marketing strategy, screening your tenant more carefully, and improving your communication with and be responsive to your tenants as a way to keep them satisfied stay at your property. The risk number 2 is damage, repairs, and maintenance. Owning a buy and hold properties means that you have to deal with any damages that occur. You may have to handle issues like wiring, landscaping, plumbing, roofing, and more. You also have to cover the cost of fixing any appliances or system that break down or any major damage caused by natural disaster or accidents. These repairs can reduce your cash flow significantly. Moreover, if your tenant changes frequently, you will spend more money preparing the property for the next renters than if you had a long-term tenant. To avoid expensive repairs, you should do the following things. Before you buy a property, inspect it carefully and identify any major issue that need fixing. Then, include this cost in your analysis and fix them as soon as possible after closing. This will make your tenants more satisfied with your property. Next, save 1% of the purchase price as cash reserve to cover any repair that may arise while your tenants live in your property. Alternatively, you can save 5% of monthly rent as a cash reserve for future big expenses. Finally, conduct a property inspection every year. Ask your property manager to check if there are any problems that need to be addressed before they get worse and require more costly replacements. Number 3 risk, decreased rents. Landlords have been enjoying steady rent increase in the last decade, but now in 2023, things are changing. Some markets are seeing rent stabilizations or even rent deductions. How can you protect yourself from this risk? Here are some tips to help you avoid rent decrease. First, do your homework. Make sure you invest in real estate market that has solid economic and demographic factors that support a high rental demand. Buy in areas where more people own than rent. Where there will be less rental competitions, lower supply usually means higher demand and higher prices. I recall in 2008 market crash, many landlords had to lower their rents to fill their vacancies because there was too many rental homes available. Before you buy a property, check the rental market demand. If there are many rental listings, you may want to adjust your number and see if your cash flow still meets your return expectations. Lastly, look for property in a good school district. Most families who can afford it want to send their kids to better school. They are willing to pay higher rents for their kids' education. This will create a strong support for your rent. Number 4 risk, decrease property value. Similarly, property value has been rising steadily for the past 10 years, but now it seems to level off or even decline in some markets. This poses a potential risk for real estate investors. Here are some tips to help you reduce your exposure to the falling property's value. Choose your market wisely. You need to do your homework and research the real estate market you want to invest in. Make sure the market has strong and stable population and job growth, as well as affordable housing options. This factor create a high demand for housing and support property values. Stay away from oversupply. Don't buy in area where there are more new homes being built than people moving in. When builders have excess inventory, they will lower their prices to sell quickly. This will drag down the prices of existing homes in the area as well. I remember what happened in the Phoenix, where the property prices dropped in half from their peak because of the oversupply in 2008. Don't fall for FOMO, fear of missing out. Don't invest in overpriced property that generate negative cash flow. Buy and hold is a long-term strategy that requires patience and discipline. It will take time for each cash flow and property value to increase with the inflation rate of 2 to 3% per year. Invest in property that produce positive monthly cash flow that can cover your expenses and build your reserves. Monthly cash flow can help you survive any economic shocks, such as tenants losing their job, not paying rent. Cash flow can also preventing you from selling in panic when property values drop. Risk number 5, market volatility. Before you invest in buy and hold strategy, you should do your research to minimize the impact of the market volatility. You can do this by analyzing the real estate market and the investment property you are interested in. You can also look for opportunity to invest during the expansion phase of the market when both sales and prices are going up. Moreover, you should ensure that your property is affordable for your target renters. Investing wisely can bring you many benefits in the long run, but you should also be aware of some of these potential pitfalls that could affecting your return. This include unexpected maintenance costs, low occupancy rates, or stagnant market conditions. However, with careful research and planning, you can avoid or minimize this risk and enjoy a profitable and rewarding investment experience. I hope you enjoyed this content and learned something new. If you did, please show your appreciation by giving this video a thumb up and share it with your friends and family. That way, YouTube can show it to more people who may benefit from it. I really appreciate your support. That's it for today. Drop a comment below and tell us what other challenges or pitfalls you are faced and heard of what when it comes to investing in real estate. Thank you so much for watching. Let's learn, invest, and make an impact. Ciao!